Good afternoon, everyone, and welcome to our fourth quarter market outlook and a review of the third quarter. Today is October 23rd, 2016. This is Bruce Connors for BlueKey. Taking a look at the S&P 500, here's the SPY chart, which is an ETF of the SP 500. For the year, it's been a good year so far, plus 7.79%. That includes dividends, and the third quarter, June 30th through September 30th, plus 3.83%. So it was a really strong quarter. Here are some of the highlights in terms of the news. Early on in July, 10 and 30-year yields hit all-time lows. We said at our webinar on July 23rd that we thought there was a good chance that those interest rate lows would be the end of the bull market in bonds that's been going on for 30 plus years, starting from the 1980s. So we think over time interest rates are slowly going to drift higher from this point. Payroll numbers have been really strong throughout this recovery, indicating that a recession is not around the corner. We did have some soft numbers at the beginning of September, but the market actually rallied to those numbers. If you look around September 1st, September 6th, the ISM index signaled a contraction for the first time in 6 months, and U.S. service sector gauge hit a 6-year low. One of the interesting things about the market is over the last few weeks it's been up one day, down the next, that kind of pattern. And one of the things that sets the market off is fear of interest rates. So when interest rates, it looks like interest rates might rise, maybe sooner rather than later, the market sells off. That's what happened on September 9th. September 12th, which was Monday, Fed governors came out and spoke dovishly. It was going to be lower interest rates for longer, and they were going to be very gradual, and the market rallied to that. Market has also been up and down based on oil prices. So when oil prices fall, the market falls in sympathy, and when oil prices rally, the market goes up. And you see that happened on back-to-back days on September 14th and September 15th. Same thing on September 28th, oil prices jumped on a possible OPEC accord to limit production. And to close out the quarter, there were fears that Deutsche Bank was running into serious trouble, and the market sold off on that. So again, for the quarter, plus 3.83%, it was a strong quarter. Looking at asset class performance year to date, we see that emerging market equities have been the big winner, plus 16.4%. And if you look over the last, let's say 3 years, 2013 to 2015, you'll see that EM equity was towards the bottom of asset class performance in each of those years. So we're seeing some reversion to the mean, and this chart shows why you need a diversified portfolio. As asset classes go up, they go down. Style box returns, this is for the entire year. The third quarter is in the right column, and you will see everything was in the green for Q3. The big winner was small cap growth, plus 6.62%. Sector returns. Technology, plus 10.6% for the quarter. They're plus 13% for the year. And utilities were down 5.94%. And that, of course, is because of fears of interest rates rising. So utilities down. And for the year, energy plus 19.45%. Looking at the fixed income markets, and this is in the year-to-date column, you'll see emerging market debt also performed really highly, and that's in local currency, plus 17.1%. And again, you look at 2013 to 2015, that particular category finished last in each of those 3 years. Same in 2011. So we would definitely due for a strong rally in emerging market debt denominated in local currency. Looking at commodities for the quarter, not that great. Silver was up, plus 5.27%. Oil down, and agriculture down. Let's take a look at the economy. The Atlanta Fed publishes GDP now, which is a kind of estimate for future growth as the economy moves along, as time moves along. So for the third quarter, they're looking for growth of 1.9%. The New York Fed publishes the Nowcast, which is similar to GDP Now, although they use a different methodology. They're looking at Q3 growth of 2.3%. And if you take an early look at the fourth quarter, the New York Fed's Nowcast is looking for growth of 1.6%. That's as of today. So for quarter one, we had growth of 0.8%. Q2 was a little bit better, plus 1.4%. For quarter three, the final numbers aren't in yet, but if you take an average of the Nowcast and GDP Now, let's call that 2.1%, and the early Q4 estimate is 1.6%. So basically, we continue with low growth in the 1 to 2% area in the United States. You look at a BlackRock model, that's the green line there. They're looking for GDP over the next 12 months of 2.25% growth. So growth, again, is going to continue probably to be low in the 1 to 2% range, maybe a little bit better, but we don't see a recession around the corner. Each quarter we take a look at some conditions that often precede a recession. It's very hard, even for the best of economists, to see a recession coming, but we take a look at these four factors because in the past they've been a good indication that a recession might be on the way. So let's look at accelerating inflation. And if you look at the green trend lines, you'll see that inflation usually accelerates at some point before recessions, which are marked off in the shaded area. However, all the way off to the right, you'll see right now we don't really have accelerating inflation. Although that might change as inflation has picked up just a little bit over the last month or so. An inverted yield curve is when interest rates going out in the near term, let's say 3 months to 2 years, are greater than interest rates going out 10 years to 30 years. So right now we definitely don't have an inverted yield curve. If you look at the chart on the right, you'll see that interest rates are lower in the near term and higher in the long term. The chart on the right measures the Treasury spread. It's the 10-year bond minus the 3-month bill rate. And you'll notice before most recessions, the spread goes to less than 0. Rising inventory to sales ratio, that has been going up recently, although the last couple of months it has ticked down. Rising jobless claims, this really has been the strongest part of this economy, of this slow growth economy. Jobless claims continue to be very, very low. As a matter of fact, they've been pushing 30-year lows in terms of initial jobless claims. Here's a look at number of non-farm payroll jobs that have been created, and over in the red column, that's September. The United States created about 150,000 new jobs. So it wasn't the worst month, it wasn't the best month, it was kind of somewhere in the middle. Here it is again, you'll see on the left, plus 156,000 in September. The good news is the chart on the right, the number of 25 to 54-year-olds now looking for work has gone up over the last couple of months, and that indicates that the job market is tightening. People feel more confident that they can go out and find a job. So conditions that often precede a recession, we looked at these four charts. Accelerating inflation, no. Inverted yield curve, no. Rising inventory to sales ratio, we put that as a yes, although the last couple of months it's really been going down. Rising jobless claims, no. So we think, at least in the near term, there's not a major threat of a recession, barring any unforeseen, economic or political event. This is a chart that does worry us a little bit. It measures consumers that see a higher chance of missing a payment over 3 months, and you'll see that that has gone up recently. So that would not be good news for the economy, and we'll keep an eye on that. Here is the political risks event calendar. Of course, the big event is November 8th, the United States election. We think the markets are pricing in a Clinton victory, along with the Republicans maintaining control of the Senate and the House. Should Trump pull the upset, that would increase the level of uncertainty a lot, and I think the markets would react negatively to that. Same thing as if the Democrats sweep the legislative houses. That would probably be a negative event, at least in the short run. After the U.S. election, you have Italy and then Austria, and then going into 2017, you're going to have the beginning process of Brexit, which could upset the markets. Let's look at the economy around the world. This is the composite of leading indicators. It's made up of 35 countries plus 6 major non-member countries of the OECD. And you'll see that for the last 6 months, the composite of leading indicators has been trending up. So that's a positive sign for the global economy. If you remember from past webinars we've done, we've been saying that we're on a global recession watch. But it seems like economic indicators around the world have been improving and moving away from a possible global recession. This is the Centex Economic Index. This measures investors' perceptions of different economies around the world. And if you look around the world, it's pretty much most investors are pretty positive. Eurozone, they have an upturn. Germany is a boom. Asia, ex-Japan, boom. Latin America, upturn, etc. So around the world, investors are feeling better about global economies. Purchasing managers' indexes have been moving up across the globe the last couple of months. Here's a heat map of the global purchasing managers index. If you go all the way to the right, you'll see the most recent months, and you'll notice there's less and less green as you move into the current month data. So these are all positive signs. Not that the global economy is going to begin taking off, but at least we're on a track of slow growth and moving away from the threat of a global recession. Here's a chart of the Chinese currency, the yuan. We have to keep an eye on the yuan because that set off a big sell-off in the United States at the beginning of the year and around the world. We've been saying all year that there's going to be a gradual depreciation of the yuan, and that has kind of been the case, although it's accelerated over the last couple of weeks. So that's something that we have to keep a close eye on. However, the Chinese economy seems to be doing somewhat okay. Here's the producer price index. This came out recently, and it turned positive for the first time since January of 2012. The economy also expanded at 6.7% in the third quarter based on the official Chinese statistics. Even that might be exaggerated a little bit, but at least China is showing positive growth. So China appears stable for now, and that'll help the world economy. Looking at the oil markets, you can see on the bottom chart on the lower left, the number of active rigs has been declining for a while now since the price collapse, and inventories have been starting to slow. You look further up above to the inventory change, and you'll see how inventories were being added in 2014, 2015, 2016. But for 2017, it looks like for the first time in a long time, supply and demand are going to be in balance. So that will help the price of oil, and it should prevent a collapse in the price of oil. We think slowly over time the price of oil will drift up, probably into the $50 to $60 range. The really big topic is the Federal Reserve. We think the Fed is going to increase interest rates in December. That'll be the first interest rate increase since last year. And as long as the economy continues on a slow growth path, we think it would be good for the Fed to slowly increase interest rates over time if we could get back to a more normalized level. If we get an increase in December, and then as long as there's a slow rate of increases thereafter, and if corporate earnings can begin to pick up, we think the market should be able to hang in there and possibly do okay. However, the risk is if there's an acceleration in the rate of interest rate increases and we get 3 or 4, that might be a little too much for the market to handle. Or if corporate profits do not begin to pick up and they continue to be flat to down, that also would hurt the market. We have shown this chart before in past webinars, and this shows how the S&P 500 has performed a year later in a slow interest rate cycle. That would be a cycle where you're increasing just 1 or 2 times during the year, and a year later the market's been up 10.8%. But if you look down a couple of rows below that, in a fast cycle, which would be more like 3 or 4 increases, the average change has been negative. So the market can increase if interest rates go up at a slower pace. This chart shows market pullbacks of 5% or more. The last pullback we had was about 115 days ago, and the average time frame for a pullback from one to the other is 105 days. So we're probably a little bit past the average or median point for a pullback. You can get a pullback at any time, of course, but it wouldn't be too surprising to see a correction of 5% or more before the year's out, given all the political uncertainty and everything else going on around the world. This chart shows how earning estimates come down over time. So let's look at the first 3 bars on the left, and you'll see this was for the third quarter of 2016. In March, S&P 500 earnings were expected to be 22.1. In June, that was lowered to 19.2, and by October, it was 15.3. So let's talk about earnings for this quarter. If you look off to the right for Q3 2016, that's for the quarter that just ended. Corporations are reporting earnings right now. So analysts are expecting earnings to decline by 2.1% for that quarter. If that happens, that would be 6 quarters in a row of negative earnings growth. Obviously, the market cannot continue at this level or to advance if earnings don't increase. However, if you look off to the left, second quarter 2015 as an example, once you get into the actual earnings reporting period, usually the actual earnings come in better than the expected earnings. So in this particular example, you'll see analysts were expecting a decline of 4.6% in the dark blue bar, and the earnings came in at negative 0.7%, that's the light blue. So the actual earnings came in 3.9% better than estimates. And that pattern is pretty much held over the last several quarters. So if that pattern continues, and right now analysts are projecting negative 2.1% for this quarter, there's a decent chance that earnings will come in flat or maybe even positive, and that would put an end to the streak of 5 consecutive negative quarters. Going into Q4, analysts are projecting 5.6% earnings growth and 5.3% revenue growth for the S&P 500, and thereafter they're expecting positive growth. Now let's talk about valuation. You hear a lot of people say the market's way overvalued, and then there are other people that say it's undervalued. So if you look at traditional metrics like price to earnings, price to book, price to sales, the market is overvalued. Look at the chart to the left and you'll see the current forward price to earnings ratio is 16.5, but the 5-year average is 14.9 and the 10-year average is 14.3. So just looking at the PE ratio, yes, the market is overvalued. However, you have to take into account the current level of interest rates, which is really close to all-time lows. So basically, investors have 3 choices. You can invest in cash, you can invest in fixed income, or you can invest in equities. So right now you're making pretty much nothing with cash and minimal with fixed income. So equities are more attractive right now when comparing it to interest rates. So in that case, equities are probably in the zone of fair valuation. So if you're looking at traditional metrics, yes, the market's overvalued. But when you take into account the entire investment landscape, you can make a pretty good argument that the market is close to fairly valued. Here's a chart. This shows the price to book value. So if you go off to the left, you'll see the S&P 500. The blue diamond represents the current price to book of the S&P 500. It's 2.9 times book, and the 10-year average is 2.4 times book. So the market is overvalued by that metric. If you look out at the Russell 2000, which comprises smaller stocks, it's not that out of line. It's 2.1 currently versus 2.0, the 10-year average. And in terms of sectors, pretty much everything is priced higher than it normally is, except for energy and financials. Now looking around the world, off to the right is the Russell 3000 index of U.S. stocks. You'll see it's 2.8 times book compared to a 2.4 average. But elsewhere around the world, valuations are really not stretched. They're pretty much in line with their 10-year average. These are forecasted returns going forward 1 year and 3 to 5 years. These are annualized projections, and this is from State Street Global Advisors. So you look at U.S. small caps, they're projecting 7% annualized return. U.S. large caps 6.5, emerging markets 9.7. Now these might be a little bit optimistic. There are other analysts and other firms out there projecting returns that are much lower going into the future. We look at this each quarter. This is the Morningstar fair value of the median stock of all the stocks that are rated by Morningstar. So Morningstar rates 950 different stocks, and coincidentally, the ratio today, which was, well, this was actually a few days ago, but the ratio of the price of the median stock in that universe compared to Morningstar's estimate of its fair value is 1.00. So it's exactly fairly valued. So based on this particular metric, the market is not that overvalued. Based on this, it's fairly valued. Of course, that's just of a median stock in their universe. So you look at interest rates around the world, and this is getting back to why equities are up above their normal price range in terms of price to earnings, price to book, etc. This is debt, fixed income, around the world with negative yields. So in Western Europe, well, take France, $1.4 trillion, Germany, $1.4 trillion. Japan is the big one, $5.7 trillion. The rest of Western Europe, this is excluding France and Germany, $2.7 trillion. And you look at the blue bar graph up top, you'll see even going into September of 2016, the negative yielding debt worldwide has really not declined. In fact, it was up from August. And here shows just how much yield on selected assets has been declining. This chart is from BlackRock. You'll see the green dots showing the pre-crisis average compared to what it is now. So everything, or most everything, is yielding way less than it used to. And all of this helps explain why equities are at elevated levels based on traditional metrics. Here's another chart. This is dividend yields versus the 10-year Treasury. Now traditionally, the 10-year Treasury would yield more than the dividend yield of the total stock market index from Dow Jones. But as of October 22nd, that's not the case, and that hasn't been the case in the last few months. So right now you can get, if you own the overall market, you're getting a dividend yield of about 2.02% versus 1.74% if you buy a 10-year Treasury. Plus, you would be getting all the growth of the stock market. And hopefully, in theory, if history repeats itself, even in these slow economic growth times, there'll be some growth in the price of your stock. So you're getting the dividend plus the capital gain. So it's a much better deal than owning a 10-year Treasury. Now that yield, that spread has come down from 0.50% on July 22nd, 2016. That was the last time we did the webinar. So you can make an argument that the market is not as good of a deal as it was a few months ago, but based on history, it's still a pretty good deal based on this metric. This is a chart of the 10-year Treasury. Right now the rate is 1.74%, and you'll see it's up from 1.37% on July 5th. The July 5th number of 1.37% was literally the all-time low for the 10-year Treasury. And we do expect it to slowly rise from here. There's lots of evidence that inflation is slowly starting to pick up. So the Fed will probably increase interest rates in December, and then, slowly increase rates thereafter. So good chance we have seen the low in interest rates. So where is the market going to go from here? If you remember in our last webinar, we did an exercise with the dividend discount model showing how as interest rates go down, the price of equities would go up. So today we're going to work on the simple PE ratio, price over earnings, and see how that impacts the price of equities. So we'll look at the S&P 500. So the closing price on Friday was $21.41. The calendar year 2016 expected earnings, and this is for the entire year of 2016, including the quarter that just began, is expected to be $118.20. And you see that off to the left in the black circle. So the PE ratio of 21.41 divided by 118.20 is a ratio of 18.11 times. So investors right now are willing to pay 18.11 times expected calendar year 2016 earnings. And that's how you get the price of 21.41. So we know that over time, as interest rates rise, that might be more attractive for investors to put some money in fixed income and take away from the equity markets. So the PE ratio is likely to move lower if interest rates increase over time. Now the big question is, what is the PE ratio going to change? Nobody really knows the answer to that. But let's assume interest rates rise 2 times next year and the PE ratio falls from 18 to 17. And let's look now at the calendar year 2017 earnings, which are estimated to be $133.30. Now, to me, that sounds kind of optimistic. That would be a huge increase. So let's split the difference between 133.30 and 118.20, and we'll assume that calendar year 2017 earnings comes in at 125.75. So if earnings is 125.75, and the PE ratio is going to be 17 next year, multiply that out, the expected price of the S&P 500 would be 21.37, or about where we are right now. So what I'm trying to show here is that the price going forward, using the simple PE ratio, is really a function of how much people are going to be willing to pay for earnings next year. And how much people are going to be willing to pay for earnings next year, a lot of that is going to have to do with how fast interest rates have increased, what the level of inflation is, etc. And of course there are other things, there's all the uncertainty with the political environment and everything else in the world. But just keeping it to, forgetting everything else that's out there, just keeping it to interest rates and earnings, those are really the 2 big variables that are going to drive where the price of the S&P 500 is next year. Can earnings increase fast enough to offset the decline in the PE ratio going forward? To me, that's the big question over the next few months and the next year. Anyway, thank you for listening to this quarterly webinar. If you have any questions, please feel free to contact us. We want to remind you that we have a weekly newsletter which kind of fills in the gaps between the different webinars. And if you have any questions, again, feel free to call us. Have a great day, and thank you for listening.